Greetings and thank you for joining us at FutureMoneyTrends.com. I am here with the smartest and best money manager I know. He's an absolute overachiever and over-deliverer. Very important to us. You know, when I look at other hedge funds and fund managers and money managers, I really, it's really hard to find those exceptional people who are always putting their clients first, the people who are investing with them, the people who are making that commitment to writing a check into someone helping them grow their net worth. And certainly this is a person that I highly recommend you listen to, Nicholas Green of FMT Advisory. Nicholas, thank you for joining us on the show today.
Thank you for having me, Daniel. And in fact, it's a pleasure to be on your program because I don't know if there's any two people out there more than you or I that spend more time researching and delving into the true proven leaders out there that are running real businesses. And I think me and you really share that conviction that we want to partner our money with truly exceptional, exemplary management teams that have great assets, and we want them at good prices. And so we're very aligned on that, and so it's a pleasure to be on your show. Nothing more than for that.
Thanks.
Reason.
Yeah,
so
well,
thank you for having me.
Well, thank you very much for those kind comments. Yeah, it is so important. People are not speculative. Projects are speculative. Businesses are speculative. The economy is speculative. But if you partner with good people with high integrity who are overachievers, that is not speculation. Nicholas, let's talk about what's going on in the gold market before we hit anything else. A lot of people have invested in the precious metals sector over the past year. They've made a ton of money, and over the past 6 weeks since the middle of August, we've had pretty significant correction. It was just a moderate, mild correction until last week when we did see the GDXJ fall through that support line of 40. And I think today as we do this interview, it's around probably 38, 39. So what are your current thoughts on the gold market? Is the bull market in danger that we've believed possibly is or potentially has started here? Or is this just part of resource investing?
Well, I don't think it's in danger at all. In fact, I'm pretty bullish on the precious metal mining sector on whole. If you think about it, there's an old saying that I really like. In bull markets, bulls make money and bears lose money. In bear markets, bulls lose money and bears lose money because it's really hard to stay short in even a bear market. And so if you translate that to the mining sector on whole, it's probably even more pronounced. So in bull markets, I'm guessing a lot of people don't actually make money. And the reason why is because it's an extremely volatile sector, and volatility scares people. And so you can have a major bull market. In fact, if you look at the mining sector from 2000 to 2010, I think it went up 1,700%. But probably very, very few people were able to hang in there through the whole thing and with the ups and downs because of the massive volatility. So one way to do that if you're an investor, especially if you're a do-it-yourself investor, is just make sure you're not overexposed so you can handle that volatility. If you put 10, 15% of your assets in there, if you have a really strong conviction and the sector sells off 25%, your portfolio is only down 2.5%. But it's in a bull market, but you don't want to get shaken out of it by these events and these big, huge moves that look nasty on the surface. But it's just part of the sector. It's a very volatile sector. The mining shares are still cheap relative to the price of gold, and that cheapness will work itself off over time. I don't have any predictions on how it continues to work itself off, but it's in a nice little bull market. This is just a pullback, and I think it'll at some point consolidate and we'll start moving back higher again. But don't let the volatility shake you out if you're convinced that the sector is cheap relative to gold, and that there's a lot of catalysts to move it forward. So that's in fact, it's really interesting, but I have sort of this saying that 70, 50, 10, right? 70, 50, 10 it's unsustainable. And what's 70, 50, 10? You've got a 70 times gold to silver ratio. You've got demand for silver at about 50 times more per ounce of silver than for gold. And then it only gets mined at about 10 times silver for every ounce of gold. And that's what's really happening in the physical ground. And 70, 50, 10 is unsustainable. And silver prices are unsustainable down here. So whatever the narrative is, whatever the narrative is with the paper money pushers, it doesn't matter. Eventually the physical markets will take over, and the unsustainable nature of 70, 50, 10 won't last, and it'll converge, and it'll go higher. The unfortunate thing about the gold and silver sector on whole is it tends to want to move on fear or negative news. There's no reason why it shouldn't just move on fundamentals. And the fundamentals, there's a lot that are supporting and backing the fundamentals in the sector. And it's unfortunate they don't move just based on the fundamentals, and they don't. So they'll it tends to need a catalyst of one sort of another to move it higher, which is ridiculous because I own lots of great businesses that don't need catalysts and they move higher based on the fundamentals. But for whatever reason, I don't know if it's a narrative or just the way the sector trades, but there's plenty of catalysts that will move it forward, and value is its own catalyst over time. So just don't get shaken and take appropriate size positions and stay the course. You'll make out great in the sector.
Well, Nick, and it's always something, right? So for the past year, literally, it's always been that the Fed is going to raise rates, or the Fed is going to kick the can. But even on the days they announce that the Fed is going to kick the can, out of the same sentence from Yellen or the media, they'll say, but it's going to happen next time. So even though it didn't happen this time, we still got the headwind that we got to wait for the next 60 days or whatever it is before they do another one. In fact, they're doing another one right now as we speak, I believe. And then in December or November, they'll get together and, same thing. So over and over and over, you've got these catalysts of why gold shouldn't go up or why it should go up. Honestly, it's just noise. I think everybody knows that listening to this show. When you look at the Federal Reserve and its actions over the past year, they were supposed to have 4 rate hikes, I believe was it 2015 or maybe it was this year, but they were supposed to have 4 rate hikes. They only got to 1 in December. And now, literally, we are in October of 2016, and weekly in the market have they priced in that the next hike is just around the corner. And here we are, almost a year from the first rate hike, and we're still talking about the same BS that we were talking about a year ago. What's the Fed's position? Is this all one big bluff?
Absolutely, it's a big bluff. If you and it's incidentally, it's bizarre to me that the markets and market participants, the ones that are out there, don't do a little more basic back of the envelope math. But it's for sure a big bluff. And if you really listen to what the Fed says, in fact, in the Jackson Hole meeting, I can sum up this whole Fed talk with one line. The Fed has to err on the side of inflation, period. And that's all anyone needs to know from an investment allocation standpoint. They have to err on the side of inflation for so many reasons. But they've even said essentially those words. Janet Yellen said that they continue to anticipate gradual increases in the Fed funds rate that would be appropriate over time to achieve and to sustain employment and inflation near their statutory objectives. Well, their inflation targets really aren't meeting their objectives. And while employment looks good, if the Fed starts this is a systematic dot plot increases, which what you're talking about when they talked about raising it 4 times. Now they raised it once. They haven't moved since. And it's because they kept them for so low for so long that they've created a lot of misallocation of capital and distorted markets across the world, from real estate to financial assets to the bond market. And unlike in 2000 when they started raising rates, that's what clobbered the technology bubble. And there was actually a large cap bubble at the time too. Even like Coca-Cola was at 40 times earnings. Most people forget that, but there were large companies that weren't technology associated that were massively overvalued. Even Buffett said it was a mistake not to sell Coke at the time. So the high quality blue chips are nowhere near the bubble they were in 2000. But anyways, it was the Fed raising rates that really choked off that bubble in 2000 and created that crash. They created the next bubble by lowering interest rates, making lending standards easy, and then you had the mother of all bubbles, which was the real estate bubble on a real dollar basis that was much bigger. And then the Fed started raising rates going into 2007, 2008. That choked off that bubble. It crashed. Well, anyone paying attention, anyone monitoring the Fed knows that the Fed, their loose policies have created bubbles, but their tightening have also crashed the bubbles. And the Fed this time around, they're really not in a position to start raising interest rates to choke off asset prices. And the reason why they can't is because this time, in any kind of deflationary scenario, it's the government that has the problem. They have nearly $20 trillion in debt. They haven't touched their unfunded liabilities or their deficits. And so this time around, we are in bubbles, but the problem is it's how the bubble crashes that I think almost everyone has it wrong on. The Fed is going to have to continue to err on the side of inflation. And inflation has a weird way of, it's one of the worst outcomes, higher than average inflation. I'm not predicting that it's going to happen in the next 6 months or years, but over the next few years, 5 years, I think it's pretty much the biggest worry out there is inflation running above target and the Fed not really being able to do anything. And it's as much of a psychological effect than anything. But the Fed really needs to err on the side of inflation, and they've so much as said so. But yet the market participants all sit back and go, oh, they might raise a quarter basis point again, and so the markets all hiccup. If gold and silver are trading naturally, which is hard to believe, it could, I suppose, indicate why they've gone down recently as well as the market a little bit. But the bottom line is this, is the Fed, they have to err on the side of inflation, and the story really ends there.
Nicholas, when it comes to the markets itself, the major indexes, I've seen so many calls for top calls. I even probably, let's see, and I want to say back maybe 4 or 5 months ago, we, in our publishing letter, stated that, we felt that the upside was limited, very limited, maybe 5, maybe 10%, but the downside could be 25 to 50%. I still believe that. However, I probably said that around 17,500. And since then, the Dow has gone on to make all-time highs. What is your current opinion of the major indexes? I know HSBC this morning just sent out a memo to clients that they thought a big crash was coming. Do you think a crash is coming in the fall of 2016?
I know people hate these kind of answers from a money manager, but it's what's kept me out of trouble as a money manager. It's also why, if you look at my accounts, it's especially if you isolated it down to individual strategies, we're blowing away almost every major hedge fund out there this year, and it's why we've stayed out of the trouble of other alternative type money management firms, and we've blown them away over time, is because we don't get too dogmatic. So take my answer with a grain of salt. But the markets, I find some good values in this market, believe it or not, even not in the resource sector, which is the most beat up sector, and the precious mining sector is probably one of the cheapest sectors out there. But I'm finding good assets even in our income money spinners, which are dominant, growing, predictable companies that have high income streams that are growing. And then even in our super investor wealth compounders, I'm finding some good values. The market is definitely on the very, very top tippy scale of expensive. But when you measure it against interest rates, a company like, say, let's just take Phillips 66, for example. It's a big Buffett company. He really likes it. I like it for retired investors. It has over a 3% dividend. They only pay out 40% of their cash flow via the dividend. The other 60% they reinvest in share repurchases with the cash flow, not debt, and then into their higher chemical upstream businesses. And so it's a fantastically run business that's on real assets, that's growing over time. So the 3+% dividend is far better than the 1.75% yield on the 10-year Treasury. So, but it's also a growing dividend. It's been growing at 40% annualized over the last 7 years, which is just remarkable. It shows you the kind of money spinner this company is, that has real assets that you can't duplicate, and it's a growing long-term business. And so is that a bubble over, say, the 10-year Treasury? No, it's a much better buy, and it's a much better buy because you also have a growing cash flow stream. But now this is the but that, right? So the overall market is expensive. There's some good investments and good values within it, but the market isn't as expensive as everyone thinks if the Fed stays low down here for a prolonged period of time, because the alternative is bonds, which are under 2%. The 10 years under 2%. You pretty much have a real negative long-term rate of return, which should also be bullish for the gold and silver. But if they start to raise, that's why you see the markets go into these big, huge conniption fits, because suddenly you have markets and asset prices, including real estate across the country, that is priced off the 10-year Treasury. I mean, interest rates set the floor on everything, and so it's either an anchor or a balloon. And it will be an anchor if they start raising rates. And so if they start raising rates, the indexes are in huge trouble, and you need to be prepared to hedge out your great long positions should they start raising interest rates. I don't believe they can, because I think they need to err on the side of inflation. But you want, instead of trying to predict or trying to invest in what you think is going to happen, sometimes it's better to invest in how things are happening. And that's how I do it over at FMT Advisory.
Nicholas, with one of the things I've done is, instead of shorting the market, because I think it's toppy, just having more cash, because essentially if the stocks go down, I can buy more. It's an easy way to short, conservative way to short.
Awesome.
When it comes to the actual stocks themselves, look, the reality is that the entire baby boomer generation is tied to the stock market. Essentially, the U.S. economy is tied to the stock market. Other central banks are already buying stocks. I think it's potentially only a matter of time before the Fed's in there buying stocks, which, instead of having the Greenspan put or Bernanke put, I mean, essentially now, if the central bank of the United States starts buying stocks on the open market, then it's done as far as having markets. It probably will just keep going up, because how could it go down if there's always a willing buyer to come in, correct?
For sure. I mean, you have Japan; they're monetizing their market, their stock market, right? The Japanese central bank is actually one of the largest now owners of the publicly traded markets in Japan, and I think that's the point why I don't believe that the market's going to necessarily crash, though it could definitely have a correction. In my much larger accounts, I mean, I'll admit it, I have some hedges against some of my longs, but I'm not net short by any means. I have some great businesses, and an example of this is a long way about answering your question, and I don't mind talking about the business now because I'm fully invested there, or invested across the board and have a great cost basis. But we own a company called Nomad Foods, which is run by Martin Franklin, who generated a 6,000% return for his investors in his last venture. Everybody needs to eat. Nomad Foods generates $200 million a year in free cash flow. It's on a market cap of $2 billion. So you have a 10% free cash flow yield, 11.5% if you include synergies, which they're still right-sizing the business based on their recent purchases. Plus, they have $600 million in cash and are on the prowl to continue to consolidate. The point is this: is you have an 10 or 11% free cash flow yielder that's going to grow over time in a predictable, dominant business with the best people managing it in the world. So that's a much better deal, again, than 1.75% on a 10-year treasury. That's not going to grow, and you could get hammered on. But I don't think people will get hammered. I don't think that the bond market is going to implode. I've heard a lot of people thinking, and even Ray Dalio said, if interest rates go up 1%, that would be the worst bond market crash since the early 1980s, I believe. And but the problem is the Fed and the government around the world, not just our government, because it would affect other markets too. They can't afford a bond market crash. Even a quick 1% rise would decimate markets. It would decimate government finances. For every 1% increase in interest rates, the government goes in hawk by, I think, close to $300 billion more a year in just interest payments now. And so back to your point about central banks and this whole facade that they're going to want to keep in continuation for perpetuity, which is impossible, but at some point there's a breaking point. But they'll go back and buy bonds at the very least to keep bond prices suppressed before they let bond prices crash and burn or burn. And so because they won't let bond prices crash, and because they will go in there and monetize more bonds at the very least, if not stocks outright, if not, heck, you got some central banks buying gold miners at this point. But yeah, they'll monetize bonds. If they felt like they needed to, they'd probably do what Japan did and monetize stocks. Wouldn't surprise me. But right now, there's some great bills out there, and you just need to stay pragmatic and understand that, look, that has to not only err on the side of inflation, but they can't allow a bond market crash either, hence erring on the side of inflation. And so that's why I don't really believe that there'll be a crash. There could be a correction, but again, it makes sense to continue to pay attention and not get too dogmatic about things.
Sure, it's very speculative no matter what, just because the Fed is in unprecedented and uncharted territory and unprecedented policy actions. Our guest today is Nicholas Green with FMTadvisory.com. Smartest money manager I know, most dedicated one certainly. Please check out FMTadvisory.com. We'll also have links up as well as Nicholas's 800 number if you want to reach out to the company. Nicholas, again, thank you so much for your time. I really appreciate it. Look forward to talking to you very soon.
Thank you for having me in your program, and you're doing a great job. Keep up the good work over there.